Fund Center. Good, good evening, ladies and gentlemen. Welcome to the pros and cons of reverse mortgages. My name is LaToya Benjamin. I serve as the director of the Du Bois Fund Center for Public Policy. We are an academic think tank associated here within the School of Business at Medgar Evers College. We focus on all things qualitative and quantitative research for all things the Black diaspora, for the social, economic, and political mobility of the Black diaspora. Here we have our legal arm leaders representing some of the top esquires in New York State, Miss Yvette Dudley and Rhonda Maco, to share about the pros and cons of reverse mortgages. And with that, I will allow our lawyers to take it away.
Good evening, everyone. Welcome to the Du Bois Bunch Center Reverse Mortgages program. My name is Yvette Dudley. Again, the other attorney associated with Legal Arm is Rhonda Maco. And we also have Don Graves that will be a speaker tonight. And we have Janay Malloy, who is from the National Association of Real Estate Brokers. NARAB, as they're called in the short title, is also a co-sponsor of this program. So again, the Legal Arm, we're going to give you more information on that, but the Legal Arm has two legal clinics. One is an estate planning clinic, and one is a foreclosure real estate clinic. At both clinics, we have, it's open to the community, and you can have a free consultation, and we go over your paperwork and your issues one-on-one with an attorney. They happen on Tuesdays and Wednesdays in person at Medgar Evers College or via Zoom. We'll give you more information on the times and locations of those legal clinics. So without further ado, we want to bring this reverse mortgage program to you because many people have reverse mortgages. Many people consider reverse mortgages, and for whatever reasons, they say yay or nay. And then once that person says yes to a reverse mortgage, there are certain issues that may arise that they may not know how to address. And then unfortunately, at the conclusion of a reverse mortgage, at many points, a person may pass away, and now the survivors are faced with this reverse mortgage and not know what to do. So this is an important program to try to figure out, number one, are you or a loved one a good candidate for a reverse mortgage? And even if you weren't, if you inherited a reverse mortgage, what is it that you do now that you're facing one on your property? Okay. So without further ado, I would like to introduce one of the speakers for tonight. His name is Don Graves. If you just ran his name through YouTube, you could find thousands of videos on reverse mortgages. He's a premier speaker on reverse mortgages. He's the president and founder of the Housing Wealth Institute and an adjunct instructor of retirement income at the American College of Financial Services. With nearly 3 decades of experience in the reverse mortgage industry, Mr. Graves has educated over 30,000 financial professionals and served nearly 3,000 clients. He is an accomplished author of 3 books on reverse mortgages and retirement strategies, and a sought-after speaker. Don is dedicated to empowering consumers and financial professionals on the strategic benefits of reverse mortgages for enhanced retirement security. So, Mr. Graves, we welcome you tonight.
Thank you, Yvette. Is it my time? Can I share my screen? I see it. Okay, I'll share it in a minute. Well, fantastic. Thank you for having me. Thank you for doing a workshop like this. It gives the pros and cons of a reverse mortgage. That's critically important to know. I know I did some work with NARAB in the Bed-Stuy community there in New York. I'm in Pennsylvania, and but my capacity, I have a team around 200 folks, and we serve 49 states. I do not serve New York, but I'm very, very familiar with the program. So I'm going to share my screen. I'm going to encourage you all to grab a pen or paper. We'll share some notes here today. Let me hold on here. There we go. That's a little better. All right. Can you see that screen, Yvette?
Yes, I can. Thank you.
Fantastic. So we're talking about using your home to dramatically improve retirement outcomes without losing ownership or giving away your children's inheritance. That's a spooky title. I like it. But this is my mini masterclass where I talk to people about using your home. My focus is on retirement income, but retirement today is going to last longer, be more expensive, and less predictable. I don't think anyone um, underestimates that. Woke up a few weeks ago and we were at war. Before that, I guess we bought Greenland over the weekend. I can't keep up with everything, but I know that because of this, when we're talking about retirement, and that's what I'm focused on, that's what I teach at the American College. My question is it important that you use all your available assets when planning for retirement? Now, most retirees have um, at least two or three of these: your income, employment, Social Security, pension, your investments, IRAs, 401ks, brokerage accounts, insurances, fixed and variable annuities, but housing wealth, 87% of retirees in America own a home. So how do we use that? How have we used it in retirement? Well, we used it when we got a 30-year mortgage or a home equity loan, line of credit, moving, selling, downsizing, or renting. But today we're talking about reverse mortgages. But that's where it gets spooky when we talk about reverse mortgages. Oh my gosh. You ever mentioned it at the barbecue? Well, what happened? Three people left the table, three people dove under the table, and your Aunt Janie made a shake out of a plastic knife and fork and came after you. It's just dangerous to mention reverse mortgages. Now, sometimes you mention people saying, well, no way, that's not for me. I'm offended. Some people say, well, I've heard these things about them. I'm opposed. But every now and again, more than every now and again, people say, well, I'm open. I want to know about the reverse mortgage. And this is important because home equity in America is significant. Currently, and this is not updated, I didn't do it for 2026 yet, but there's $14 trillion of unmonetized home equity for retirees in America. So what do we do with that? The U.S. Census Bureau said this, that the average retiring couple has less than $100,000 saved. Now, that may not be this audience or those you serve, but they have a home, they have $192,000 in home equity. Simply stated, that home equity is the largest single concentration of wealth in America. So when I talk to folks, I said, there are some folks that will talk about the cons of a reverse mortgage. I'll share that. I'm going to outlay some things for you, but you've got wonderful, gifted attorneys that are committed to justice and building generational wealth that will unpack some things for you. On the front end, I deal with retirement income planning and making sure that we can have a great retirement. So here's some questions I ask people when we start. I said, if your home could be used to increase your cash flow in retirement, would you want to see how it works? See, I asked these questions early and I simply asked folks to answer yes or no, or yes or not applicable. If your home could be used to increase your cash flow, if your home could be used to create a backup plan for market risk and volatility, would you want to see how it works? If your home could be turned into a reserve fund that could grow tax-free, potentially surpassing $1 million, would you want to see how it works? If eliminating a monthly mortgage payment meant your retirement savings could last significantly longer. If you turned your monthly mortgage payment, a mandatory one, into a voluntary one, would you want to see how it works? And here's a catch-all. If you could use your home to minimize income taxes you pay in retirement, leave a larger inheritance to your heirs, leave a larger inheritance to your heirs, leave a larger inheritance to your heirs, defer Social Security, replace income in case of loss or emergency, create a long-term care health plan. If you could use your home to do any of those things, would you want to see how it works? Well, I'm Don Grace. I'm an adjunct instructor of retirement income at the American College. I've been doing this for 26 years. In those 26 years, I've had 16,000 consumer-facing conversations, and around 3,000 people became clients of mine. That tells you two very important things today. Number one, I talk to a lot of people. And number two, I know that the reverse mortgage is not always the right fit. I wrote an article last year in Retirement Daily outlining 16 reasons you may not want to do a reverse mortgage. You can find that article at www.16considerations.com, 16considerations.com. So there I outline when this may not be a good idea. And I've written 3 books. Now, here in our short time today, I'm going to give you 3 discoveries about the reverse mortgage. It's just a mortgage, it's not a last resort, and it's more than a television commercial. Don, what do you mean? What is a reverse mortgage, folks? IJAM. IJAM. Well, Don, what does that stand for? It's just a mortgage. It's just a mortgage. It's part of a three-legged stool of a government-sponsored retirement. 1935, Social Security. 1965, Medicare. In 1988, the home equity conversion mortgage, HECM. So I remind people, it's not new, it's not dangerous, it's not spooky. What is it, folks? It's just a mortgage. A few years ago, we convened a study group, and because we were going to get rid of the name reverse and reverse mortgage. We thought, oh my gosh, what a terrible connotation. Let's get rid of that. And we convened a focus group, and we asked these people, what type of loan might you get in retirement? 30-year mortgage, home equity loan, line of credit, or reverse mortgage. And no one said reverse mortgage, not a single person. And then we changed the question. And I'm going to play just about 60 seconds to see what happened when we changed the question.
Welcome. Come on in. Have a seat.
We invited real homeowners to participate in a blind challenge comparing two home equity line of credit products, a traditional home equity line of credit and a reverse mortgage line of credit. We call this the Home Equity Line of Credit Challenge. Our groups learned that while both products let you tap into the equity in your home to help you fund your retirement, there are some important differences. They discovered that there are options for how and when to repay the loans, that monthly payments and available funds can change over time, and that only one of the products is government insured. Finally, we asked them to choose which product they preferred.
To me, almost sounds too good to be true.
That was a no-brainer.
So I'm going to reveal now what these products are. Product A is a traditional home equity line of credit. But the product you overwhelmingly chose is a reverse mortgage line of credit.
Never would have guessed it.
Does that surprise you? It sounds like it does.
I wish I had known about this before I had taken out the home equity line of credit.
It's a mortgage or it's a line of credit, but with flexibility. I haven't heard yet any reason why I shouldn't pick this product.
You're in a better position with the reverse mortgage.
So the fact that it's a reverse mortgage line of credit, how much do you know about reverse mortgages?
My view was very negative.
This cleared up a lot for me.
I feel a little more informed about the reverse mortgage than I did when I first walked in the door.
I don't think I ever, for some reason, fully understood that a reverse mortgage was, in fact, a line of credit.
I would consider the reverse mortgage now that I've heard more about it.
85 out of 88 people who took the Home Equity Line of Credit Challenge chose a reverse mortgage line of credit. Take the challenge for yourself and find out if a reverse mortgage line of credit is right for you.
You see, these folks didn't know what they didn't know. They'd heard things like I'd heard things. But a reverse mortgage is a non-recourse loan for those age 62 or better. There are programs now for age 55 that allows you to convert a portion of your home's value, turn it into tax-free dollars without having to make monthly loan payments, and you do not give up ownership or come off title to the home. The amount of money you get is based on three things: the age of the youngest borrower, the older you are, the more money you get, the value of the home, and the future projected interest rate called the expected interest rate. That's going to make a certain amount of money available. A reverse mortgage must be a first mortgage, so any outstanding loans or liens or judgments on the property have to be paid off from the proceeds of the reverse mortgage, and what remains is what's called the growing line of credit, the GLOC. The borrower's responsibilities. Have you ever heard the story like this? Well, Don, I was at my cousin Tracy's house for the barbecue, and Uncle Junebug came out of her spare bedroom. And everybody said, Uncle Junebug, why are you in Tracy's spare bedroom? He says, I live here now. And they said, what happened to your house? And here's what Uncle Junebug said. Have you heard this? He says, I got that reverse mortgage and I lost my house. And everybody at the barbecue said, I knew it. I knew it. And then Sunday they went over to the Baptist church, told the deacons. Monday went to the beauty salon, told everybody. Tuesday the barbershop. Wednesday the Kiwanis Club. And by the end of the week, someone knew someone had a cousin, uncle, had a grandfather who got a reverse mortgage and lost his house. And then they come to me and say, Don, what do you say about that? Is that true? I said, it's absolutely true. It's 100% true. Oh my gosh, you're the evildoer. We got to take you over to the church and repent. And I said, well, Uncle Junebug told the story. He didn't tell all of it, but he told a lot. See, there are 4 requirements when a person gets a reverse mortgage. At least one spouse has to live in the property. You have to take care of it. You got to pay your property-related charges. You have to keep insurance in force. Well, Uncle Junebug hadn't paid his taxes in 4 years. It was not the reverse mortgage, but it was the municipality and in this case, Philadelphia, that took action.
Why-
Not paying. Not paying. Did someone say something? So not paying your property-related taxes is no one reason that there's what they call a technical default on a reverse mortgage. So Don, when's the loan due and payable? When it's no longer your primary residence, the last surviving borrower has died, or you've gone into a facility for physical mental incapacity for 365 consecutive days. At that time, whatever proceeds were advanced, plus any interest that accrues, gets repaid. 100% of any remaining equity is passed on to the borrowers, the heirs, or the estate, and you have 6 months to repay, with extensions being granted up to 1 year. So here are 4 nevers with the reverse mortgage. You never give up ownership or come off title. You'll never owe more than the home's value. You never have to leave the home if the funds are depleted, and you never have to make loan repayments in advance of leaving the home. Now, as long as you're doing those requirements, living in the house, take care of it, pay your taxes, and keep insurance in force. Now, this went quickly because I'm protecting our time, but I teach a class all across the United States. You can access it online at housingwealthmasterclass.com, www.housingwealthmasterclass.com. So you can stop and rewind and pause. This is a mini masterclass. So I said it's just a mortgage. Number 2, it's not a last resort. See here on the screen here shows a reverse mortgage line of credit. Someone says, Don, I've got a $800,000 home and I'm 65 years of age. How much of a line of credit can I get? I said about $267,000. If I don't use it, does it grow? Sure. It grew to $100 million here. It's close to $2 million. So the reverse mortgage line of credit is a growing line of credit, a Glock. Every time I say that, I'm from Kentucky. My relatives want to add a K and make it a firearm. I said, well, it's not that type of weapon. But a growing line of credit is a powerful strategy. There are 52 retirement income strategies I teach in my 6-hour course that all are built on this right here, the growing line of credit. Now, not everybody needs that. Not everybody desires that. And so we got to make sure it's the right fit. So let's look at a few common applications here of the reverse mortgage. Now, this fella won the Nobel Prize in economics. He teaches at MIT. And he said that reverse mortgages are the potential solution for the global retirement funding crisis. Folks, I want you to understand, reverse mortgages are not about getting a new boat. It's about funding retirement. Funding retirement. I don't know what gas is now in Brooklyn. I know what it is outside of Philadelphia. Funding retirement. It's just a mortgage. It's not a last resort. And finally, it's more than a television commercial. How many of us have seen some sort of reverse mortgage television commercial? Most of us, especially in the early days. Oh my gosh, they were everywhere. But I said it's not a TV commercial. Reverse mortgages and what I teach. What are some of the strategic uses of reverse mortgages? Now, what are people using reverse mortgage to do strategically? Now, remember, I said retirement's going to last longer, be more expensive, and less predictable than most of us have imagined. Now, an average person, retiree, I mentioned this earlier, let me get a better color here, has 3 buckets in retirement. Your income bucket, Social Security, pension if you're lucky, employment if you're working, your investment buckets, IRAs, 401k, brokerage account, business interests, a real estate, house in the Hamptons, and your insurance bucket. And those buckets have to last you as long as you live. And the question is, are you 100% certain that these buckets are going to last you as long as you live, maintain their purchasing power to give you the lifestyle you want? Most people would say, Don, I'm not 100% certain. And I said, well, here's the good news. You've got a 4th bucket. And the 4th bucket is housing wealth. Let me run through these quickly. If you access the masterclass, they're all unpacked there very, very fast. Or excuse me, and not very, very fast. They're unpacked there in a little bit more detail. Mitigate retirement risk with a housing wealth reserve. Yahoo Finance wrote an article that said 14 signs that you'll run out of money in retirement. And I won't go through them, but it says you didn't have a long-term care plan. How many of you watched an aunt, a mother, a grandmother burn through their money because of a long-term care plan? My mom, at age 85, dementia required that she would spend $7,000 a month for part-time home care. My sister Donna quit her job. Michelle went part-time. And Mama didn't have a home, so that lasted 3 years. She spent $250,000, and Mama's in a memory care facility now. A lot of people will spend money. We've seen it. Maybe you're taking care of someone now. Life expectancy, healthcare costs, inflation, big ticket items. You change your spending habits, loan money to kids, spoiled your grandkids, didn't take future tax rates into concerns, got divorced, new debt, withdraw money, too much money, market fluctuations. And what I teach is that this simple line of credit can address all of these 14 concerns. So establishing a reverse mortgage line of credit for many folks is an antidote to deal with the kind of challenges that are going to face you in retirement. Managing mortgage payments. One of my favorite questions I asked, I said, Mr. and Mrs. Jones, I'm curious, if you had a choice, would you rather your monthly mortgage payments be mandatory or voluntary? What would you choose? Well, so far, 100% of people look at me like I'm crazy and say, duh, I choose voluntary. I said, so would I. So Steve and Barbara had $500,000 in retirement savings. They're doing pretty good in America. And they want to take out a certain amount of money. And if they take it out that much, their advisor says you're going to run out of money early. Well, they've got a home and they've got a mortgage on their property. 68% of people coming into retirement have some sort of house payment against their property. 68%. And so I asked them that question. What would retirement be like if you didn't have to make a monthly mortgage payment? So they did a reverse mortgage based off their age, value of the home, expected interest rate, $224,000 was available to them. Well, the first thing it did is paid off that $200,000. And that left them with a small line of credit. But what did it really do for them? The benefit was every month they were paying $1,500 a month to service that. And I reminded them that's an after-tax payment. How much money do you have to take out of your IRA or whatever? You have to take out $1,900. We'll multiply that by 12. I say every year you're going to save or retain $22,000. So now you don't have to spend $35,000 because we just found $22,000 pre-tax dollars. So you're only spending $13,000 a year. And I asked them, what does that do to your retirement savings bucket? And they understood, Don, that causes it to last almost in perpetuity. I said, you're absolutely right. And there are 9 other things that eliminating a monthly mortgage payment will do is extend the life of the savings. It reduces your taxable income. Most people don't know that if you have too much Social Security, that's going to be taxed up to 50 or 85%. Well, we can eliminate that right there. Well, we can optimize Social Security conversations. There are lots of things Don, Social Security didn't pay enough. The cost of living adjustment didn't quite cover what I needed it to be. Well, that's not for this call, but I wrote a paper, and I do a lot of teaching about 7 ways to use a reverse mortgage to strengthen your Social Security. My latest book that's coming out later this month is called Using Housing Wealth to Reduce Income Taxes in Retirement. If you could use your reverse mortgage or use your home to pay less income taxes, would you want to see how it works? I've got 12 ways that does that. Preserving assets from premature erosion. Here's a family that's got $1 million. Now watch this. This was featured on, came to New York City. It was on Yahoo Finance. They had me come and speak on their podcast. And here's a client that's got $1 million. They're doing okay. And it says, I want this money to last 30 years. Now, this is the research of Dr. Wade found. But if the money's in the market, well, you've seen this. Sometimes it dips. So the question is, if I don't have to take money out during a down time, here or here, or here. If I don't have to pull from my investments, which I need to live, and I can pull from another source, would it make a difference? And the answer was, would it make a difference? Absolutely. So in 30 years, instead of having $0, they had 800,000 or even up to 1.2 million. That's if they used a reserve bucket, in this case, a reverse mortgage. They used it one time in 30 years. And the difference was you had 800,000 or 1.2 million. What Dr. Wade Fout, the American College, went on to write about and says, what if we used it 4 times? Instead of taking money out of our portfolio, we took it out of our reverse mortgage bucket. It says, what would that do for us? Well, it says all things being equal, 30 years later, instead of having $0 left, you'd have $4 million left. And this was counterintuitive. This was a shot heard around the world, that the reverse mortgage didn't take anything away from the heirs or the estate when used in this way. Now, not everybody. Remember, there are 52 ways to use it. So these are folks that have money in a portfolio and they're living off of that. And we say, here's something you can consider. You can consider. We're using it for long-term care. There's my mom. She's 93 now. My Uncle Richard, he's 91. And mom's in a memory care facility and she's doing fine. She doesn't know who I am. But when I get to see her, she looks up and said, "Ma, you're handsome." I said, well, she still got it. She still got it. But I talk a lot about long-term care. The Department of Health and Human Services says 70% of retirees are going to need some form of long-term care. It's the biggest overlooked and underplanned for expense and retirement. Well, how do we use our home to begin to kind of manage that and prepare for that? And finally, adding new dollars to retirement savings. If there's a way we can increase your cash flow, reduce your expenses, and add new dollars back to your retirement, but it involved moving to your next, last, and best home, would you want to see how it works? Last year, I wrote a paper called Building Generational Wealth with Reverse Mortgages. I presented it at the Conference of African American Financial Professionals. I'll be back there in August sharing again. And I said, I want to show you how we can build generational wealth with the reverse mortgage. And I said, you understand generational wealth is more than just money. How many times did you saw someone left money to Ray Ray and Junebug and they burned through it? Generational wealth is wisdom, it's strategy, it's education, it's discipline. But I'll do just a quick example of buying your next home with the reverse mortgage. Sometimes that's the best option. If we do more of these than anybody in the country. So here's a person, Don, I had a home at $600,000 and I sold my home. That's fine. And I paid off the mortgage I had and I've got $500,000 left over. And they downsized to a $400,000 home. So instead of just paying cash, he said, well, I got $500,000, I'll pay cash. And I said, no, let's draw a reverse mortgage triangle for you and see what that does. And here's what happened. The reverse mortgage made $160,000 available, so their down payment is $240,000. Well, where did they get that money from? Right? They got it from proceeds from their home. So the benefits, they moved into a new home, they have no monthly mortgage payments, and they have $250,000 left over. But let's go to Bed-Stuy. Well, here's an example. Don, my home is now $1.2 million. The taxes are up, the maintenance are off the chart, the insurance is expensive. And I said, if you sold the house and you had this money left over and you moved to an $800,000 home, I want you to see this. Don, I could pay cash for this. Yes, you could. Or we could do a reverse purchase that made $300,000. Now you've got to come up with $500,000 to add to the reverse mortgage. Well, Don, where did I get this? You got it from the $1.2 million. So you moved to a new home, lower taxes, less maintenance, and you had $700,000 to add back to your retirement savings, maybe do something with the children, the grandchildren, the great-grandchildren, or just sustain your retirement. So folks, that's my little talk. It's just a mortgage. It's not a last resort. It's more than a television commercial. There are 52 retirement income strategies that a reverse mortgage can accomplish. I know this. When I talk to folks, I said, there are 8 alternatives to getting a reverse mortgage. I've told more people, remember, I've had 16,000 conversations, and someone said, Don, you've only had 3,000 people that went forward. I said, I've told more people, I wouldn't do this. Not only did I tell them that, I wrote about it. I showed them 16considerations.com why this may not be a great idea for you. But you can find a lot of that at housingwealthmasterclass.com, or you can find me at askdongraves.com. Well, I'm 25 minutes. I'm at my time. Now I'll hand it back to Yvette. Thank you so much, Yvette.
Thank you for that, Mr. Graves. Thank you for that informative presentation. I was even taking notes. And I'm going to put your information in the chat. I'll put your bio in the chat as well. Okay. And if you can stick around, we'll have questions and answers after the presentations from everyone. If anyone has any questions, they could also put those questions in the chat.
Yvette, unfortunately, I'm going to have to jump here because I've got another appointment coming up. I got stacked this evening. But if you put my information in the chat and someone wants to email me, I'm happy to answer the questions. But I wanted to thank you for what you're doing, your advocacy, your justice, for getting the information out, for protecting folks. Sometimes they're unscrupulous lenders, they're bad deals, things that go wrong. And I'm grateful for folks like you that are there to help New Yorkers in this endeavor.
I did start off by saying you have about 1,000 YouTube videos, so I'm sure you're about to add to that tonight.
Well, thank you. I've got to jump. Thank you, everybody.
Okay, take care of yourself.
Bye now.
So next we have Rhonda Maco, one of the attorneys from the legal arm, and she will be presenting on the common pitfalls of reverse mortgages. Rhonda Maco has been an esteemed member of the New York State Bar, practicing law for over 20 years. She's a fierce advocate for justice and works hard advocating for her clients as well as her community. In 2009, she founded the law office of Rhonda Maco, which is located in Garden City, New York. She also has the spearheads the legal clinic for estate planning, which is held on Tuesdays. Again, we'll give you the information regarding that during this program. Now I present to you, Ms. Maco.
Thank you so much, Yvette. Can everyone hear me?
Yes.
Okay, yes. Good. Okay, great. So thank you for this. This is a wonderful webinar, and this is one that we wanted to do for a while because we understand that a lot of times we have clients who come to us who have reverse mortgages. Sometimes they inherit these mortgages from the house that they inherit, and they don't know really what to do. So Mr. Graves did a wonderful job of just telling us about ways we can utilize reverse mortgages and how they can benefit us. And that's wonderful, and that's what we want to do. But what we also want to do is talk about the pitfalls, and that's really what I'm going to focus on right now. He did bring up some of those pitfalls, and I'm just going to go into some of the common themes that we see when we come across people who have reverse mortgages. So I'm going to share my screen. Can you see that?
Yeah.
Perfect. Okay. So I'm just going to run through this quickly, talking about the common pitfalls that we come across when we talk about reverse mortgages, right? So sometimes people get into these mortgages and they don't fully understand what they're getting into. Not all reverse mortgage companies are equal. As Mr. Graves was talking about, you have to really understand what you're getting into. And if you get the right company, you can make this work for you. But what we see is that there's a lack of understanding. So let's just make sure we're clear on what we're talking about here. So with reverse mortgages, there is no monthly payments required, right? So a lot of times people think that that means there's nothing that they have to do, but that's just not the case. Although there's no monthly payments required, the loan has to be repaid upon death, sale, or if there's a default. And we see a lot of defaults, and that's what we want to try to prevent. So with the reverse mortgage, although there are no monthly payments, you still are required to pay taxes, insurance, and there's an occupancy requirement. So you have to make sure that you're staying on top of these things so that way there's no trigger, there's no default trigger. So let's talk about the first pitfall, the failure to pay property taxes. That's one of the common pitfalls we see with reverse mortgages that, again, you're thinking that there's no monthly mortgage payment, so I don't have to do anything. That's not the case. You have to pay the taxes. It's the leading cause of default in the state of New York when we see these reverse mortgages. Failure to pay property taxes. You still have to pay those taxes. And keep in mind also, in New York City, the taxes are better than on Long Island. A lot of the taxes on Long Island are very high. So when you have this high tax burden, and people think that they don't have to pay a monthly payment, but then you still have to pay those taxes. So if you're talking about a house that has a $13,000 tax base, that's over monthly mortgage payments. That's the first pitfall. Insurance lapses. So you have to pay the homeowner's insurance that must be maintained on the property. So if you do not have it, the lender can force you to place insurance. This is the same thing that happens on a regular mortgage, by the way. There are some people who have mortgage payments where the insurance is not included in the mortgage. Most of the mortgages today include that insurance, so you don't have to worry about it. But for reverse mortgages, you have to make sure that that insurance is maintained. And if not, they can force you to pay that insurance. And the failure to not have insurance on the home can lead to a default. And to trigger anything, so you want to make sure that you have that insurance in place. Number 3, non-borrowing spouse issues. So again, you have to be very careful when you decide to get a reverse mortgage and make sure you understand what you're getting involved in. We've seen many of cases where there's only one spouse that's on that gets the reverse mortgage. So the spouse that's not on the loan may lack certain protections. So if you are married and at the time you got the reverse mortgage, that your spouse is not on the loan, then we have to talk about that, because you have to make sure that there are certain protections. You must meet certain HUD eligibility requirements. So you have to make sure. Oh, can you guys see my screen? Let me see.
It stopped.
It stopped? Oh, okay. Let me stop sharing. Let me stop sharing and then reshare again. Let me share again. Okay, can you guys see that now? You can? Okay. Sorry about that. Because I want you guys to write these things down. Let me just go back real quick. If you didn't see this one, the second pitfall was about insurance lapses. So you want to make sure that there's insurance on the property. Like I said before, the lender can force you to place the insurance. And usually when the lender does that, that insurance is going to be way more than if you went out and procured it yourself. So keep that in mind. And also it can trigger a default. So we don't want that. The third pitfall is about the non-borrowing spouse. So again, everybody has their situation, but if you're not going to include your spouse on the loan, then they may not have certain protections. Okay. So you have to understand that there's certain eligibility requirements. The spouse that is not on the loan does not have access to the loan proceeds. So if, God forbid, the spouse who is on the loan passes, then there's certain protections that will not extend to the non-borrowing spouse. So these are some issues that will have to be dealt with. I'll talk a little bit about that some more later, but I just wanted to bring that to your attention. The fourth pitfall is leaving the home. Okay, so if you have a reverse mortgage on your house, that has to be your primary residence. Okay, you have to be at the house. If you're absent for over 12 months, that's going to trigger a default. So, sometimes things happen. You might have to go into a nursing home or something like that. If you're absent for over 12 months, that will be a default. And that happens when you have long-term care stays. Mr. Graves had talked about long-term care planning. But if you have long-term care insurance in place, you might have options that might come into play where you don't have to stay in long-term care for 12 months or over. So just keep that in mind. You have to be at that residence as your primary residence. And then pitfall number 5 is property maintenance. So the home must meet certain basic condition standards. So you can't let things just go. If your garage is dilapidated, if there are violations on the home, that will trigger a default. So keep in mind that you are in that home, and if things are the outside of the home shows that there's some type of violations, your neighbors can report you. And the building department can show up. It happens all the time. So people think that just because they're not going to do something that no one's going to find out. That's not true. There are plenty of times when the building department will show up at your door and for a violation. Because if you have neighbors, which we all do, and there's something that you failed to do that is affecting other people, then they're probably going to report you. So you have to understand that that might be an issue. So, and you don't want any type of code violations to be triggered. So you have to make sure that you maintain the home and make sure that everything is in order. So if you try to delay certain maintenance, that might create a risk for you that is going to work at to your detriment. And then again, the sixth pitfall is that the misunderstanding about no payments. I can't tell you how many times people get that confused. When we say no payments, that does not mean there is nothing for you to do. I have to reiterate that because this is a common problem that comes up all the time with reverse mortgages. Borrowers think that they have no obligations because they don't have to make a monthly payment. That is the biggest misconception, and it will get you into deep trouble. You have to pay the taxes, you have to have insurance, and you have to upkeep the residence. If you do not do these things, they lead to defaults, and these are defaults that can be preventable. Also, just keep in mind, if you're not paying these taxes, the lender or the mortgage company will periodically check to see what's going on in the home. You may not think that, but they will. That's how they'll know that, the taxes are not being paid. They'll inquire. They will, go down to the clerk's office or something like that, or something will trigger that will make them do some more investigation. So if the issue is taxes, now they're going to try to investigate and find out if there's anything else that's a problem as well. So one thing can turn into four things, and the next thing you know, you're in default, and then now we're in trouble. So just keep in mind that you have to be prepared and you have to really understand what you're getting into. The seventh pitfall, heirs are unprepared. So this is a difficult one to talk about because, sometimes the heirs have no idea what's going on. And the only way that they'll know what's going on is if the homeowner talks to them about it. So this is a communication issue. A lot of times homeowners do not want to let their loved ones or the next of kin know what is going on. And God forbid something happens and the homeowner passes away. Now the heirs inherit this home with this reverse mortgage on it, and they don't know what to do. And sometimes they freeze up. So it would be the best course of action is for the homeowner to speak to the next of kin, or if you're the next of kin, you're the heir, speak to the homeowner. If that's your grandmother, if that's your mother, find out what's going on and try to prepare as much as you possibly can. You can't make someone tell you something that they're not going to tell you, but you can engage and make sure that you have conversation and about what's going on with the home and what the homeowner wants to do, and how are they going to pass down the home. You can start there, so that way you can start to engage and see what they're going to tell you, because the loan becomes due at death. And see, that's when heirs a lot of time find out that there's a reverse mortgage on the home. That's not the time when they should find out, but that's unfortunately what happened. Heirs must act quickly. So again, when heirs find this out, sometimes you just go into a panic because it's overwhelming, which is understandable. But you have to act quickly. You have to either sell or refinance, and a lot of times heirs are not positioned to take on a refinance. And they just don't know what to do. And then sometimes they just wait a long time. And then by then, the interest has compounded and the loan has accrued more. It's eating at the equity, and now we're in big trouble. So the best thing you can do, granted, this was not something that you anticipated, but you have to be able to act. Sometimes we freeze up when we get information like this, but we have to be in a position to just say, listen, let me just get an advice from someone, speak to an attorney, and find out what you should do next. Missed deadlines leads to foreclosure. So, that's the process that you would find yourself in as the heir. They're trying to foreclose on the home. And again, that whole process of foreclosure, which Miss Dudley will talk to you about, is a very, it's scary. And we understand that it's scary, but you have to really understand that you have to communicate as quickly as possible so you won't find yourself in that position. Pitfall number 8, title and estate planning issues. So I deal with a lot of estate planning. And, we try to make sure that we give all the different options and educate as much as we possibly can. And again, when it comes to reverse mortgages, we find that, when the homeowner passes, that's when we find out all the information that we should have found out, a long time ago. But you can't do anything once you find out this is where you are. You have to deal with whatever issues come up right where you are. So one of the pitfalls is the non-borrowing spouse is not on the title. So that is an issue because, then they are not entitled to certain things. And now you have to jump through hoops in order to try to keep the house. And again, communication solves a lot of these problems. You got to be able to communicate so that way you don't find yourself in a position where you're trying to prove who you are to the bank. Now you have to apply all over because they don't know who you are, and you might not be able to position yourself properly in order to save the home. Also, there'll be conflicts amongst heirs. Again, if the homeowner does not speak to the next of kin or the heirs, then now everybody's looking and scrambling and trying to figure out what to do. In order to avoid conflicts, which is what we try to do when we plan, you need to talk. Say, listen, this is what's going on, and this is the information, contact information, how much is owed, how much equity is in the house. All these conversations need to be had beforehand so you can prepare. And when something happens, you'll be positioned to take action quickly and appropriately. Once again, if you have no estate plan in place, there'll be probate delays, and that creates a risk. So let's just say you have this reverse mortgage, the homeowner passes away. Now, the loan has to be paid back or the house has to be sold. There's no estate plan. Now, no one knows who you are. So now you have to go to court to administer the homeowner's estate. That's a minimum of 7 months.
Oh.
And probably more, depending upon where you are, what county you are, what borough you are. Every court is different, but you have to wait. And so now you have to act quickly, but now you have to go through the courts and you have to wait a certain amount of time. The courts get backed up and it's beyond your control. So even if it takes 7 months, that's just 7 months to have the estate opened. And that's not including the number of deaths that may take place at the time that you file. There are so many different variables that you have no control over that happens in the surrogate's court that will delay you getting letters of administration. And that's what it's called when you don't have a will in place. So, you know, you have to really think these things through. That's why estate planning is very important, especially when you have a reverse mortgage, but even if you just have a regular mortgage, you really have to start planning proactively so that way you don't find yourself in these type of situations. So listen, if you have a reverse mortgage and you know the homeowner passes away and you find yourself in foreclosure, it will be foreclosure just like you had a regular mortgage on your house. Meaning in the state of New York, there are certain protections, right? So it's not going to happen overnight in terms of someone coming in and putting you out of the house. I mean, there are protections, but what you do have to do is contact an attorney so that way they can represent you in court, right? So they're going to serve you or they're going to do whatever it is they're going to do, but you need to have someone who's going to be able to advocate and fight for you in court so that way you understand what's going on. So you'd have to get a 90-day pre-foreclosure notice. There's also mandatory.
Rhonda, I think you froze. Rhonda.
Did the recording stop? Did something happen? I froze. Okay. All right.
We want to hear you.
Okay. All right. So let me reshare my screen again. You can see that, right? Okay, good. I'm almost finished. So, you know, again, there is a process. It's not going to happen overnight, but you need to get the proper, you know, counsel so that way you can go through the process and possibly save the house and get all of the options that are available to you. So, what's the takeaways from all of this? Reverse mortgages are not risk-free. Okay? They're not. Again, people focus on the no monthly payment aspect and think that, you know, okay, I'm free and clear. That's not how it is. It's not risk-free. Most defaults are preventable, but you have to know how to prevent them. You have to know what you're getting into. You have to know what to do when something goes wrong, and you have to act quick. And then proper planning is essential. So once you find out if you're the homeowner who has the reverse mortgage, or you're the heir who's going to inherit the home, you need to speak to the homeowner and make sure you understand what's going on. Look at those statements so you understand where the homeowner is and how much is owed on the property. Understand what the equity is, and all those different things will help you understand how to deal with a reverse mortgage. So as Mr. Graves said, you know, there's advantages to having a reverse mortgage, but you have to know what those advantages are. A lot of times we get into reverse mortgages and not fully understand what we're getting into. And that is what the problem is. And the next thing you know, we're in foreclosure. The statistics, I'll get the statistics and send it to you guys about how many people lose their houses to reverse mortgages. And it's astounding. And so we want to try to prevent that. And we want to make sure we understand what we're getting into so that way we can protect ourselves and protect our loved ones. So I'll stop sharing my screen. We'll talk about a few things later, but I want to make sure that everybody gets to talk. I'm sorry about the freezing a couple of times. I'm not sure what's going on, but it happens. But again, just be informed about reverse mortgages. And once a situation comes your way, just learn to act as quickly as possible. So that way you can protect yourself and your loved ones. So I'll give it back to you, Yvette.
You're muted.
Thank you, Rhonda. That always happens once to each person. Thank you, Rhonda Maco, for that wealth of information that you gave for the pitfalls of reverse mortgages. Again, when people are confronted with a reverse mortgage, the good times are where a person voluntarily takes out a reverse mortgage. The bad times are when the heirs inherit the reverse mortgage and now they're faced with paying off the entire mortgage. Either that or sometimes the borrower again will default by not staying compliant with the reverse mortgage. So I'm going to talk on two areas. One is what happens when an heir inherits a house on a reverse mortgage. And the other one is if the house happens to go into foreclosure. Okay, so when a homeowner dies, when that borrower passes away, that reverse mortgage is due and payable. The moment that person passes away, the entire loan is due and payable. The survivors will not have a chance to make installments on the loan because it's not an installment loan. The entire loan is accelerated and it's due. So once the bank, because the bank doesn't find out right away, and I'll get to that in a minute. Once the bank finds out that the borrower has passed away, the family will receive a 30 days notice saying that the borrower passed away and that the family or the heirs would need to start making preparations to pay them in full. That's a 30 days notice. Now that 30 days notice, that timeline should not scare you because you still have time. If you're not responding to them or you have not communicated to them how you plan to pay off the mortgage, and more importantly, if they have not received their money, then they will have to foreclose within 6 months. They can't begin that foreclosure process before 6 months, according to federal law, but after 6 months, they can begin the foreclosure process. Now that family, of course, is going through the emotional turmoil of just losing a family member. And then they have to deal with the financial turmoil of how do we save the family home, or how do we address this mortgage that's on the family home. So that mindset of the heirs should be either to save the equity or save the home. Some homes may still have equity, even though you have a reverse mortgage on there. And you can either save the equity by liquidating the house and collecting the money, dispersing the proceeds among the family, and restart anew someplace else with that money. Okay, that's part of the generational wealth. Or that family can meet and decide.
Very looking to that.
Pardon me? Or someone could decide to save the home, just keep that home in the family. So we'll go through that. So when someone dies and that entire mortgage is due, you can pay off. Some of your options are you pay off the entire balance. You can pay off the entire balance. If the amount due is very low, maybe you just have that savings someplace. You can also do a short sale or a short payoff on that loan, which Janay Malloy would get into. Some heirs can decide to refinance that home, which I will get into, or you could do a deed in lieu of foreclosure. A deed in lieu of foreclosure is, you know, you're about to go into foreclosure and the family can make a decision that they don't want to save the home. The home is underwater. There's nothing that they can do. They don't want to be bothered with a short sale. So they'll fill out paperwork to transfer that home back to the bank. There are certain conditions that have to come with it. Usually the home has to be vacant and can have no other liens on there, but that's another option. And then some people will just continue to collect rent on the home until it's finally auctioned off, which is just a walk away. Remember, a reverse mortgage is only against the borrower, which means it's a non-recourse loan against the heirs. So the heirs, no matter what, would never be personally liable in that loan. They could put the deed in their name. They could do all these things. They would never have to, it would never show up on their credit report. They're never personally liable in the loan. So there are a few things that a person can do when that borrower passes away. But I am a litigator. So my approach to most things is to make sure I have position before someone else has position. So when that borrower passes away, it's important that you position yourself before the bank position themselves. Position yourself before the bank position themselves. And what do I mean by that? When that borrower passes away, the bank's primary goal is to make sure they collect all the money as quickly as possible. So they're trying to set their file up for foreclosure. They're trying to figure out who to sue. And of course, you're going through the arrangements with your loved one. Now, once the bank is able to sue, you're not ready really to defend yourself in a lawsuit because you probably, the heirs probably have not yet had someone appointed the head of the estate. So my position is always make sure the heirs and the family position yourselves first. My rule of thumb, I tell clients, you don't have to tell the bank right away that the borrower has passed away because you haven't positioned yourself yet. The bank needs just only a couple of pieces of information before they're able to foreclose. One, they need to know that their borrower is deceased. So they need to hear from you that there's to provide a death certificate. Now, once a death certificate is provided, that's part of the information that they need. The second thing they need from you is in order to sue, they have to make sure they sue the right people. Now, if there's someone appointed the head of the estate, they just sue that one person. If it's in a trust, then they sue the trustees. If no one has been appointed the head of the estate yet, there's no administration, there's no executor, the will has not been probated, then the bank is trying to retrieve the information from you, from the heir, to figure out who are the legal heirs of the person who passed away, who is the spouse, who are the children, if some children have predeceased someone, who are the grandchildren, but they're trying to figure out who are the legal heirs. And once the bank has that information, they're ready to go. They wait their 6 months and they're ready to sue you in their lawsuit. So if you call them and you tell them the heir has passed away, then you give them the death certificate. And then in the conversation, they're asking you, expressing their condolences, and then asking you, who are the heirs and where do they live? Now you have completely armed that bank with everything they need to start their lawsuit against you in a foreclosure. And you cannot defend yourself yet because you are not the head of this estate. So again, do not give the bank information before you as a family, before you are ready to proceed and figure out what are we going to do with this home. You need to secure the mail that is coming in for the reverse mortgage, number one, to figure out who the lender is and to figure out what is the account number. Now you can try to call the bank and tell them the person passed away and try to get a payoff letter. But again, the bank is very, very selfish in giving you information, but very, very active in retrieving information. You would try to get a payoff letter so you can see if the bank is, if the house is underwater or not. You want to see if the mortgage is higher than the value of the house. And if it is or isn't, it would try to provide a path for you. When the person has passed away, before you contact the bank, you may tell them they passed away, but never, ever, ever give out the heirs' information as far as their names and addresses. There is no reason at all to give the bank that information, ever. Now, what you're going to do is you're going to try to consult an attorney, by the way, to try to become the head of the estate. If there's no will, you become the administrator. If there is a will, the will has to be approved by the court. It has to be probated, right? And as Rhonda said, that process takes a while. Now, there are things that we could try to do to file emergency or urgency affirmations to tell the court that this house is in foreclosure or we are trying to pay the debt right away. Can you expedite it? But expedite to you may have a different definition to what the court means by expedite. So it still may take a while. But once someone is the head of the estate, now they're in a position to defend themselves. So let's say you do go into foreclosure. You're in foreclosure and you're served with foreclosure papers. If you are the administrator or the executor of the estate, you must answer those papers. Remember, not answering foreclosure papers or any lawsuit for that matter, it doesn't stop it. Actually, it makes everything just so much easier because now only one party is speaking in court and you're not there to speak. So you have to answer those papers within 20 to 30 days. If you miss the deadline, then the case definitely goes on without you. If you're not the head of the estate, there's a way possibly that you can answer those papers as a distributee, but you would just try to see an attorney to figure that out. You would want to, my rule of thumb again, is to try to be the first one to file to be the head of the estate. Okay, usually it's a priority thing that the court has, but usually the first one will win. So you want to try to position yourself to be the head of the estate in your family. So then you can make the decisions for that. And you need to rush and do that because some of the heirs may start selling their percentages to an investor. And now you have more problems than to just try to address this reverse mortgage. So you want to try to position yourself as the heir of the estate. Now, once you file your petition in court, because remember, now the bank knows their borrower is deceased, and they're trying to position themselves to make sure they serve the right people in their foreclosure. So all eyes are on the court. As soon as you file your petition, the bank is looking at your petition, because on your petition that you file in surrogate's court to be the head of the estate, you have to list all the names and all the addresses of the heirs. So now, of course, we have no choice, but we are giving that bank information to try to position themselves to go ahead and start the foreclosure. But once again, if you're served with the foreclosure, you definitely answer, because as soon as you answer the foreclosure in New York State, the bank is mandated to now, the courts are mandated to have a foreclosure settlement conference within 60 days. So as soon as the court gets your answer, a foreclosure settlement conference will be scheduled under New York State law in that courthouse. And a foreclosure settlement conference is basically you're in a small room, maybe on Zoom, maybe in person, depending on the county. But it's a small room, the judge isn't there, just a referee, and they just want to figure out, what are your plans for the mortgage? What are your plans for the mortgage? And of course, you would have had that conversation with your family. And once you verbalize or relay a plan to the court, then it's possible that we could delay the foreclosure for a while, because while the case is in the foreclosure settlement status, the foreclosure does not go forward at all. Everything stops. And then we figure out, what are we doing? If you're saying you're going to list it with a broker, they give you some time to do that. If you're saying you're doing a short sale or any other option, they'll give you some time. And once they see you ran out of options, that's when they'll tell the bank to continue their foreclosure case. Even if those plans aren't working out too well, and the case is released from the foreclosure settlement conference part, in a foreclosure case, in a reverse mortgage case, you can still litigate it. I mean, there are still so many issues in a foreclosure of a reverse mortgage that you can still litigate that house. But remember, every single day that passes by, the reverse mortgage is going higher and higher and higher, because you're not making a mortgage payment like a regular mortgage. That mortgage payment theoretically is coming on top of your loan. So over a course of a year, that balance on your mortgage could be raised $50,000, $75,000. So we want to, time is against us, but if we have to litigate a reverse mortgage case, there are many, many reasons why we could actually get a reverse mortgage dismissed or delayed. We could talk about standing, which is the legal right of that bank. Remember, a note may move around from different banks. So we're saying that the bank may not have standing. We may say that the capacity of the borrower was not correct when they took out a loan. Remember, this loan mainly is for seniors, and some seniors are compromised mentally. So the mental capacity of the borrower may have been at issue. We could always raise that. Not only that, the bank has to comply with certain conditions and before they bring that lawsuit to court. And maybe they didn't do that. Or maybe it's a spouse, as Rhonda talked about, a non-borrower spouse. So only one spouse went out and got the reverse mortgage. Now, it depends on when that reverse mortgage was procured, because in the past, yes, if a non-borrower spouse, if a spouse dies and there's a spouse who did not sign on to that mortgage, before HUD was allowed, or banks were allowed to go ahead and foreclose on that non-borrower spouse. Thankfully, they changed the law. Litigators, like I remember I had to bring a lot of lawsuits against HUD to force them to stop their reverse mortgage foreclosure against that non-borrower spouse. Now, even if a spouse did not sign the reverse mortgage, the bank has to wait until that spouse passes away or moves out of the house or defaults in some other way. And lastly, remember, the bank is asking on any foreclosure and a reverse mortgage, the bank is always asking for money. And many times they're wrong. So we can always challenge the amount of money that they're asking for. But the key is, again, the time frame is against us. So if we want to save the equity, the best thing to do is to, if you want to liquidate and just disperse the mortgage, the sales proceeds, you sell fast. Now let's talk about if the house is underwater. So if the reverse mortgage, because remember, it's escalating so fast, the reverse mortgage has now exceeded the value of the house. So we can't list it with the broker, because regardless of what price that broker gets, it won't be enough to pay off the mortgage. Well, it depends on what you want to do with the house. If you as a family decided that you do not want to keep the house, then of course you could do a short sale, which Janay Malloy would get into. But if the family wants to keep the house, but that the family owes more than what the house is worth on a reverse mortgage, they have a federal rule that's called the 95% rule. And that 95% rule, I'll put it in the chat once I'm done, is a federal law that says, and it's also in the body of your mortgage. So if you ever read the reverse mortgage, it's in there, that says that an heir, once they prove that they're an heir, that they have a right to have the bank do an appraisal of the home, and the heirs have a right to pay off the bank at 95% of the value of the home. So once the appraisal is done, whatever that appraisal says, the heir has a right, the heirs are heir, the administrator has a right to pay off 95% of that appraised value. It's best to do that when that borrower first passes away, but you can do that all the way up until that house is auctioned. I mean, once the house is auctioned, many of your rights are now far gone. However, anytime up to the auction, you have a right to ask for that. We had a case where a mother had died and they left a reverse mortgage for a son. And that reverse mortgage, the balance on that reverse mortgage was about $900,000. We were trying to fight the foreclosure. We were trying to get position for him to become the head of the estate. All that took time. Eventually, there was a sale date on that house. We brought an order to show cause. We told the judge to have the bank order an appraisal of that house. The appraisal came back at $500,000. Even though the reverse mortgage balance was $900,000, the appraisal came back at $500,000. Our client ran out and got a loan at $475,000 and paid off that loan and saved the house and kept it in the family. So every reverse mortgage has that clause, and it's a federal right that an heir has to pay 95% of the appraised value. You would just have to show, number one, of course, that the borrower is deceased, and somehow that you're related to that borrower. You could do that with a birth certificate. Okay. An appraisal is also, on a deal like that, an appraisal is also good for only 120 days. So from the time that they were the appraisal, you would have to, as a family or as an heir, try to get a loan within that time. When a person passes, if you kind of know the value of that home, then you should try to get a pre-qualification letter anyway, if you're trying to keep that home in the family. So there are various options that you can do in order to save the wealth, save the equity in that home, or save the home itself. Okay, you talk as a family, which one heir or which two of us or which three of us or all of us as a family want to keep the home and go out and get a mortgage and refinance this home. If your house goes into foreclosure, if the reverse mortgage goes into foreclosure because the borrower did not keep the the taxes and the insurance up to date, there are remedies for that. That's the only way that you can try to reinstate this loan. One quick way is just file bankruptcy, just file a Chapter 13 on it. And then the Chapter 13 court will, number one, ask the bank to try to give you a payment plan on it. And if they don't, then you can try to create a Chapter 13 plan over a 5-year period to just pay those taxes and insurance back. And if they still didn't, then in Supreme Court, when we have those foreclosure settlement conferences, again, the bank, the court is leaning on the bank very heavily because these are defaults where the senior is still in the home. So there are many strategies to keep a home once the house goes into foreclosure or once that borrower dies. But the rule of thumb, the mindset is that we need to act fast and you need to either save the equity or save the home. So now we will move to Janay Malloy. Janay Malloy is a realtor, and she is the regional vice president of the National Association of Real Estate Brokers, which is a national Black real estate group. And she will speak on her expertise, which is selling homes. And she will speak to you on short sales and just listing a house. So, Janay Malloy.
Thank you, Yvette. I greatly appreciate it. Thank you, Rhonda. This has been a phenomenal information. And for Mr. Don Graves, right? A phenomenal individual, what you guys, tremendous information. And I hope you're taking tons of notes because this is priceless. And I do ask one thing for everyone that's listening to us today. Do not, and this for everyone in this room, do not keep this information to yourself. Make at this very moment, write down 2 to 3 names that you're going to call them and say, hey, listen, I learned something phenomenal today and I wanted to share it with you. Right? Because many of our seniors, honestly, whether they're talking about it out loud or not, are looking at reverse mortgages as an option. They're hearing about it. Someone's talking to them about it. And it is not you, someone else will speak to them about it. So why not let it be this community that wants to make sure if they're going to do it, they do it right and they have the right information. Because we know that many of our seniors are struggling financially, right? In a city like New York, it's costly to live. So we want to make sure that we support them in any way we can, and if it's in making a decision. And we also need to identify, and I know that Mr. Grace spoke about this earlier, that the reverse mortgage is also a means of legacy building when you use it as a strategic plan in your wealth building and estate planning. Right, so when we think of it as, oh, we need to do a reverse mortgage versus in a space where, you know what, we want to do this because we strategically thought about how we can help our family, maybe buy a home for someone else in the family or downsize a parent. We've really given that some thought. So also let's think about it in that way. Let's not forget to think about it in that way. But if we're at the place where your loved one has passed away and now we're like, what do we do? What happens next? And Yvette and Ms. Rhonda both spoke on that, but I want to just delve a little deeper in a different direction. So number one, you decide to keep the home as a family. What happens next? So as Yvette said, you want to first figure out, you need to get a payoff from the bank because you got to figure out if we got to keep this thing, how much is it going to cost us to keep it? So we need a payoff. And this is why I say you should definitely reach out to an attorney or a reputable attorney and a reputable real estate professional, because you need to know how to have that conversation. As Yvette said, the lenders are very smart. They know exactly what questions to ask and how to get information out of you, right? So it's strategic, it's organized, and it's systematic. Your approach to getting this done has to be strategic, organized, and systematic to get it completed, right? So make sure that you're doing that. So we need that payoff because we need to know, can you afford to buy the house? How much is it worth? That will be kind of your first entry to information. And then you can make an educated decision about what's next. I always ask the family to consider, number one, also is there life insurance? Oftentimes people are not thinking about it. Is there a life insurance policy in play that can help maybe continue to, to pay this off? You got to look around, search up, figure out what your parents had or your loved one had in place and figure out if there's life insurance in place. And if your loved one is thinking about a reverse mortgage, that may be one of the conversations you really want to have. Let's put life insurance in place because the family wants to keep the home when you're gone. Because they may need their money up front. They're not concerned about the sons and the daughters and the nieces and the nephews. They're like, listen, I want to go on a worldwide cruise and I want to go now and I'm going to use my house because this is what I built it and I saved for all these years, right? But what the family could do and the siblings and the kids could get together and actually pay a life insurance policy towards their family, paying into their future legacy. And I know that's not something that most people really think about, but if you know that your parent has received has gotten a reverse mortgage, you may want to think about seeing if you can get them insured so that you guys can protect instead of paying, several $1,000s in a mortgage later on, you're paying maybe several $100s up front to protect your legacy down the road, right? So just a smart part of that strategy. But if they haven't, and let's say now it's like, how do we buy this thing? Do we have life insurance? Do we have savings? As you guys said, you need to get pre-approved for a loan to see if you can actually afford to buy this home. Again, let's try to do that before you notify the bank. Get your ducks in a row. So you're going to get pre-approved, which means what? What do you need? Just like you're going to buy any other home. You're going to need, your pay stubs. You're going to need your bank statements. Your W-2s, 2 years worth of W-2s, 3 to 4 months worth of bank statements, and a couple months worth of pay stubs, right? Just to get started. And you need to have decent credit. Because now you're going to be moving from like, hey, that's my mom and dad's home to now I'm going to be a homeowner. And maybe that conversation needs to happen with your entire family or the ones that are going to be responsible for this process. And I'm a big advocate of families doing things together. I know people say, oh, we can't work together. Yes, we can. We can. Trust me, you can. You don't like your neighbor, you don't like your landlord, but listen, you got your sister and your brother there, make nights with them and at least make it happen if you can, right? That would be my suggestion. Figure out what you need to get pre-approved and also understand, especially if you're a first-time home buyer, there are so many options available. There's down payment assistance to help you buy this home. You can still buy it with all the other down payment options that are available. FHA, 3.5% down. Some programs require 1% down. There's gifting that you can get that's available. There are all these things when it comes to being a homeowner, particularly a first-time buyer. If someone in the family is a first-time buyer, you all get together and get behind that person and make them the best first-time home buyer that they can be. You got time to get their credit in place, put the savings in place before you're notifying the bank. Remember, Yvette says strategize first. Get your leverage first. Take the time to do that. And once you've done that, now we can approach the bank and say, hey, listen, we're looking to purchase this home. And we want to help, we want to now negotiate. And you can actually negotiate with them. I don't know people, you guys know that. You can actually negotiate this loan with the bank. And Yvette talked about the 95% rule. So there's space and there are different things that you can do to actually purchase the home. So understand that you're not just left out there. You have options, and that's the word that we have to keep talking about. What are the options that are available to us? Now, let's say, you're like, we can't afford this house. We just don't want it. We live, we're in Florida, the house is in New York, or the house, wherever the house is. We've decided we want to sell it. We're going to take the equity and move on with our lives and just continue to celebrate our love. So here's what that looks like. That means now you got to put the house on the market. If the house has equity, what is equity? Equity means this is the amount you owe. You owe the bank $200,000, right? The house is worth $500,000. That difference is equity. So $300,000 is what you have in equity. So once we understand the payoff, we can now look at what equity looks like. And equity simply is your part of your profit that you're going to make on selling the home. So once we determine what that equity number looks like, because we got the payoff in hand, we can start to market your home, and we can start to say, hey, listen, hey, and walk you through the entire real estate process, and we're not going to go through that today, but we'll walk you through the entire real estate process of selling your home. Remember, finding a reputable real estate professional. We are realtors, we're realtors, and we're also realtors. We're the premier network of Black real estate professionals throughout the country. And we hold each other accountable when it comes to how we do business in our community, right? So reach out to your realtors, find us on nareb.com, nareb.com, reach out to us or reach back out to Yvette and the Voice Bunch Center here, and they'll be able to share information with you. We'll make sure we put some information in the chat so that you guys can connect. But find a reputable real estate professional that can represent you and represent you and your family well. And make sure and you should get an appraisal on your property, I'm going to say. Just like Yvette said, get an appraisal so you know what your property is worth. Your real estate professional can give you a what's called a comparative market analysis, which says, here's what other properties just like yours or close to yours are selling for in the neighborhood. And that way you'll have an idea of where you stand when it comes to equity and what you and your family should expect when it comes to once you're selling the property. And they'll walk you through what that sales look like, marketing it to the broader public, how you want it marketed, making sure that the buyers are coming in are approved and the offers that you're going to be looking at are really good offers that you can actually walk away with the money that you need in your pocket. And understand those numbers because those are important for you. Here's the deal, I'm also going to say, clean out the house the best that you can. Right? When you're ready to sell that house, all grandma's and grandpa's stuff is still in the house. You need to start cleaning that stuff out because everyone can't see that house the way you see it with all your loving memory. Right? They just see a house full of stuff or older furniture or whatever it is. Start to clean out the property, get it organized, air it out, you know what I mean? And if the property needs updating, please take that into consideration when you're thinking about what to price this house at when you sit down with the real estate professional, because we've sat down with people that say, oh God, the house is worth, $1 billion. But here's the real deal, it's not. It hasn't been updated in 35 years. The bathroom is still pink and blue, right? The kitchen, right, it still has wainscoting all over the place. It still has paneling in some of the rooms, right? We need to understand that somebody's got to pay down to come in there and fix that house and make it up to standard what today looks like. So you're going to take those things into consideration. And if you were going to purchase a house without what I like to call shiny, what would that shiny house cost you to purchase? So really take that into consideration, but take time, go to your parents' things, your family things, get those things out of the home, in storage, disseminate them through family, take your memories, and just make sure you take care of that, right? And present the house the best way that you can. And just be conscious of that process as you go through, because that's going to make a difference on how much money you're actually going to receive, right? How people perceive the property when they walk into it. If you can afford to do repairs, do the repairs on the house. Do the repairs on the house. I'm not saying you go crazy, right? But if there's a hole in the roof and paint chipping everywhere, fix those things. If the roof is leaking, see if you can get the roof fixed, because that takes away from your equity. Right, because no one wants to buy the house with the roof leaking, and they may not be able to buy the house with the roof leaking with the loan that they're getting. So consider the repairs that you may need to do. So when I talk about this, because remember we talked about the timeline, right? So you have to be prepared with the timeline to take care of those things as well. It may be things you're really not thinking about when you're thinking about reaching out to the bank. If we're going to do repairs, we need time to do that. We got to go raise the money to get it done. So just take all of that in consideration. Once you've done repairs, you cleaned out the house, it's looking presentable, or maybe it's just already beautiful. Now you want to say, okay, we're ready to put this house on the market, right? The agent's going to do, whether it's open houses or advertising online, they're going to do whatever it is that they do. Just ask questions, get information, stay engaged and stay informed, and be open and available. If you're not here, you're out of the state or out of the country, make sure the agent has keys to the property. These are things people never really talk about, and then all of a sudden they're hitting roadblocks and wonder why it's taking so long. And now at this point, you may have spoken to the bank. You don't got time to play with. So make sure you're dealing with those issues sooner than later. Fair enough? Once you get in, you're getting offers on the property, really consider what is it that you and your family want. You've had a discussion with your siblings or other heirs or other people involved in this conversation. You should have spoken about what this breakdown looks like what you're willing to accept and not willing to accept before you get nose deep in this thing, okay? So just make sure that you're taking those things into consideration, because you don't want, again, timelines, you don't want there to be a roadblock. Now that heirs are arguing over what we're gonna do next, right? So just take those things into consideration. And once you get an offer, the agent will move you through that process and what that looks like to get from offer to close. And your attorney will walk you through what it looks like now to handle that on the legal side with the bank, with clearing up that mortgage and so forth. So they'll help you walk through that process as well. Let's say now, so that's if you got equity, right? And I'm gonna suggest if you do have equity and you guys get that money, make really great use of that money. Figure out what you're gonna do with it before you get it. Make sure that it has a home. Your family bought this property and it still should continue to build that. It still should continue to build legacy, even if they're still gone. So how are you gonna do that? Maybe you're gonna buy life insurance policy for your family. Maybe it means that you're gonna put that into a down payment on another property. You can move, legacy doesn't need to stop with that property. It can continue on. You just need to decide how that's gonna happen, all right? Let's make our parents and our loved ones proud about what they've left in our care. Now, I also want to say that now it says, we look at the property, it is the interest has built up so much on this property, or they've had to reverse for so long that now it's what we call underwater. Means the property is worth, the property is worth 300, but you owe 600 or 700, right? That's what's left once we get that payoff number. So now it's significantly under market. It's significantly over market, essentially, right? The loan is just too much. And no one's gonna really buy it at that number that you want to sell it at. Like everything else in the neighborhood is going for 500 and you owe 700 on this house. What are you gonna do? This next thing is called a short sale or a short pay. So that means I always tell people, think of it like this: the bank is getting shorted on the money that they're owed, right? And it usually takes a little bit longer, that process sometimes, but you do want to get into that process as quickly as possible once you've figured out all the things that Rhonda and Yvette have spoken about. You want to get started as fast as you can through the short sale process, because it can be timely. It can take time to get through that, because now the bank has to agree on whatever it is you decide to market it at. You're going to hire a real estate professional that can market that property because it's a sale. It's going to be you're going to put the house up for sale, but now you're going to hire a real estate professional that's going to say, okay, well, we got to make sure we can find someone that can buy this house, buy it, and someone that can buy it at the number that the bank agrees. Because remember, they're getting shorted their money, $200,000-$300,000. They're not going to get based on their payoff. So they have to agree to whatever that number is that you're going to sell it for. And those negotiations can go back and forth for a bit of time. So you have to have an agent, number one, that is proficient in short sales and knows what they're doing and have worked in this space before. I've been working in the short sale space for probably 15 years. And anything in distress, whether probate, divorce, that's kind of the lane I've been in for a really long time. So we understand how to move in those spaces, but you need to ask your agent, how many of these sales have you done in the short sales space? Because they have to be proficient. If they're not, you're definitely going to get some roadblocks. And then you have to know how to speak and negotiate with the bank so that you don't get roadblocks. So that's what will happen in the short sale, and then the rest of the sale process works out in the very same way. And you want to make sure that the state is not held liable to any deficiencies, meaning any money that the bank didn't get, you want to make sure that the estate or your heirs or anyone is not held liable for any of that money. And that is something your real estate agent and your attorney will make sure happens. But make sure to ask that question if your family is looking at a short sale. Now, on a short pay, that is, so in a short sale, the heirs, no one receives any money, right? You cannot receive any money in a short pay. Like, you're just like, hey, we're just writing it off. We want to just make sure it's off the estates. Off the estate, we just want to move on. In the short pay, the difference is it's a slightly different process, very similar, but slightly different. And sometimes the heirs can get some degree of compensation. And that's always negotiable to some degree of compensation in the deal that can be negotiated. It could be called cash for keys. It could be moving out money. It's not going to be like the equity amount, but it could be something could be there and could be worked out and reasonable. And that's really what I want to say about when you're thinking about selling and what that looks like, or whatever the end result is. But I do want to say, be careful of predatory services. Be careful of what you're signing. Again, get a reputable attorney, because once your loved one dies, the predators come out of the woodwork, and they're looking for you. They're like, oh my God, it's like a mosquito. They're like, they're like mosquitoes, right? And you're like, you got one like a big juicy arm like me that they're ready to attack. It's like mosquitoes. So you gotta be careful, right? They're coming for you. They're coming for your family. They're reaching out to family members. You guys have to have united fronts as a family and be prepared for the predators that'll come out, because they're lending. There's predatory lending. They will try any type of issue. We talk about deed theft a lot in this city. That is a way oftentimes deeds get stolen as well. Watch what you are signing. Pay attention. If anyone ever says, oh, don't take it to an attorney, you can just read it. No. Take it to an attorney. Take it to one of these ladies you just saw here. Bring it on over here to the Du Bois Bunch Center and they'll help you out, okay? You should be skeptical if someone says you don't need to read it, you got to sign it right now. You never have to sign anything right now, okay? So I just want to leave you with that, and I just want to encourage you to reach out. Reach out, you have the information, share the information, don't keep it to yourself. Continue to reach out and educate yourself. Talk to if you have parents that are aging and above that 65 mark, talk to them. Or you got friends, talk to them. Because I'm telling you, they're having these conversations. They're thinking about this thing. They may not mention it to you. I'm going to encourage you to mention it to them. And as many people as you can, because they need to get educated. They need to arm themselves with the right information so they can defend themselves against the predators or being in a position that they did not understand. So thank you so very much. And we're around for the end of the question.
Thank you so much, Janay Malloy from NARAB. Again, Janay Malloy is a realtor who specializes in these distressed properties. So of course she could sell a home on a regular front, but her specialty is dealing with these homes that are in foreclosure or need short sales or just some type of distressed homes. But she doesn't.
Can I add something?
Mm-hmm.
Can I add something? I just want to say this.
Oh, yes.
Sorry, real quick. This is a very emotional time for families, as we talked about. You really need to have a professional that understands the emotionality of this time and the situation, because it takes a degree of extreme patience and extreme understanding to work with people that are going through mental and physical challenges in the midst of the death of their loved one. So be really conscious of who you're choosing as a professional. I just wanted to add that, Yvette, because people, it takes a lot you have to be very supportive when this is happening, extremely supportive. Thank you.
Yes, thank you, Janay. Thank you so much. I just put your email in the chat as well as information on NARAB. Now, the last part of the program, we're going to move back to Rhonda Maco, an estate planning attorney. She's going to talk about certain protection strategies that you can take with respect to what to do with your home or your family or your estate as relates to reverse mortgages.
Thanks again, Yvette and Janay. Thank you both this is just wonderful. The information that was provided today just cannot be overstated. I think that, you guys have received a lot of information, and I know it can seem overwhelming, but it's very important information. So just to recap some of the themes we heard tonight, it's number one, understanding the value of owning real property. As the homeowner, that's, the homeowner needs to understand the value, but also the heirs as well. Because, again, you find yourself in a position that you didn't think about, and here you are. And you have to understand the value of owning the home and what you can do to either protect it or if you have to sell it, everything you heard this evening was meant to help you and arm you with information to help you out of a situation that can be very overwhelming, very tedious, very cumbersome at time, and also just very frightening. So when you understand the value of the home and all the different options that may be available to you, then you'll be in a position to act accordingly. Another theme that we talked about tonight was communicating with the homeowner. So if you're the heir, or if you're the homeowner, you're married and your spouse doesn't know fully about this reverse mortgage, then communication is key all around. It's very important to communicate to everyone involved, that a reverse mortgage is there on the house, and what is the status of that loan? What is the equity in the home? And what is going on with the mortgage and what you need to do. Also, positioning yourself, this is another theme. Positioning yourself appropriately, meaning speaking to the right people, having the right consultants, speaking with an attorney. Yvette talked about, and this is key, before you speak to the bank, you should speak to an attorney. Because you need to know all of your different options, and the bank has its particular interest. They are interested in getting their money, the end. And before you make any assertions or say things that you may not even fully understand, speak to a professional who is going to help you and give you all the information that you need in order to make the right decisions. Okay, so those are the themes we talked about. So what are we doing to protect ourselves before it's too late? Well, we already talked about them, but we just want to make sure you understand. And again, I like to repeat things because there are some things that are worth repeating, because you really have to understand, and you don't want to find yourself in a situation where you're now scrambling. For seniors and homeowners, what you need to do, how to protect yourself, inform your heirs of loan existence. Now, that is one of the issues that I see regularly, where seniors do not inform their heirs of the existence of a reverse mortgage. And part of the reason is because they don't feel they have to. If they're the homeowner, they'll say, listen, this is my house. I can do whatever I want. I don't have to speak to anyone. Now, technically, that is correct. But Janay spoke about, and what I do in my practice is legacy building, right? This home that you have, that this is an asset that you have, all of your hard work to get this home. You want to make sure that this home retains its value, because it's real property, so it increases in value. It's an appreciating asset, and you want it to go to the next of kin. So in order to do that, communication is going to be key. We understand that you don't have to say anything, but if you want your heirs to have this asset that you worked hard for, it's important that you communicate with them. Also, keeping the taxes and insurance current. You have to keep the taxes current. You have to keep the insurance current. It's a non-negotiable. If you do not do that, that can trigger default, and then you'll find yourself in a situation that is going to be you trying to prove or get yourself out of a situation where now you have to defend yourself, and you don't want to do that. Maintain all the documentation for this loan. Make sure you have a file that you keep that has all of this information again. And this is information that you should share with your next of kin. To the extent that your spouse is not on the loan, then you need to share that with your spouse as well. Make sure you are in compliance with the occupancy requirements for the house. You are supposed to be that is supposed to be your primary residence. If you are absent for at least 12 months, that's going to trigger a default. So make sure you review the occupancy certifications and make sure you comply and do what you need to do. So for the families or the heirs, what should you do? know where those documents are. So if the homeowner has communicated to you that there's a file that has the reverse mortgage information as well as other estate materials, make sure you know where they are. If you have to go to probate, then make sure you do it immediately, as soon as possible. Or if you have to go to, if it's not probate, it's administration. But again, when you speak to an attorney, they will clear everything up and guide you the right way. You should contact the servicer of the loan, but again, please do not do that until you have spoken to an attorney and you've spoken to your family about all the different things that you need to do. And you really do need to speak to an attorney. I think Janay had spoke about when you decide that you're going to have a real estate broker, it has to be the right person. It's the same thing with an attorney. You might have an attorney in the family or someone that you've been dealing with that does your taxes. That does not mean that it's the same attorney that you need to use for this type of transaction. You need to get someone who is versed in foreclosures and reverse mortgages so that they will help you appropriately. Again, this is not the time to try to, just get by. You have to really make the right decisions, and that means getting the right people on board to help you and guide you the right way. So seek out legal advice as appropriate so that way you can do the right thing. So if the homeowner has communicated to you early about this reverse mortgage, educate yourself. Educate yourself even more. So if you have the file or you have copies of the reverse mortgage, make sure you understand what's going on. Look at the statements. Ask the homeowner, can I get the most recent statement so I can just see what the balance is? And then understand the equity. Speak to someone about, when was the last appraisal done? What's the current value of the home? Get all of that information so that way you can keep up with what's going on. So, these are the type of protections that you want to make sure, you are current with, so that way it's not too late. You want to make sure that you're informed. You want to make sure that you speak to the right people. You want to keep on top of this so that way you don't get overwhelmed. And trust me, when something like this comes along and you find out there's a reverse mortgage, it can be overwhelming. We are very concerned and we are aware that it is overwhelming, but you can get through it. You really can. You just have to stay calm. You have to act as quickly as possible. Speak with your family, speak with an attorney, and then you'll be guided through the process appropriately. And you can do it. Back to you, Yvette.
Thank you again. Again, I would like to thank all the speakers tonight, Don Graves, Janay Malloy, and Rhonda Maco. Many of us, we lose our homes in foreclosures and reverse mortgage foreclosures, not because we don't care, but because we just don't have the right information. The Du Bois Bunch Center, we put out these programs monthly, sometimes a few times a month on various issues. We implore you to join our mailing list so you are kept abreast of the different topics that we have. We're discussing DOB violations, estate planning, foreclosures, any issue that relates to real estate or estate planning. We try to have a seminar or a program on, and workshops where you could come and meet one-on-one, and we'll try to handle the issue that's facing you. So again, join our mailing list. I put registration in the chat. Does anyone have any questions?
Right. That's the only thing you got to do.
If no one has any questions, then I know we have some individuals that's on site now where we can assist them with their issues that they may have. Again, I'll turn it to our executive director, LaToya Benjamin. Ms. Benjamin, and I also want to thank Aaron Jimenez. He's assisting us in making sure everything goes smoothly, and he's at site at the Du Bois Bunch Center.
Yvette, we do have one question. I believe Bianca has a question.
Sure.
Go ahead, Bianca.
Is she still on?
She is. Bianca,
Okay,
if you could
I
just...
had to unmute myself. I'm sorry.
Okay. Mm-hmm. Sure.
I have a question. I have a statement, but first, the information that you gave was really, really good because my mother had a reverse mortgage and I didn't really understand it. I didn't ask the questions, and afterwards, things that I should have asked her, I didn't ask. So what you said is very, very good. You need to find out how much the mortgage is, what's due, and everything. So that's very good information. But the question I want to ask is, my mother did say to me that she wanted to start paying it back. So would that have been an option to pay back the reverse mortgage while she was still living?
Yes, you can pay the whole thing back. You don't have the luxury as a regular mortgage. It's not an installment mortgage, right? So you can't pay half. You can't make payments on it. You either can pay all or nothing. So if she took out a reverse mortgage and the balance is $350,000 and she wanted to turn that into a regular mortgage for whatever reason, yes, a person has the option of paying the entire.
Okay. Now, one more question. You because I paid back my mother's reverse mortgage, and this interest was unbelievable. And I know you just stated why the interest can go up so much, but what is the reason again that the interest goes up? You could say $50,000 to $70,000 in 1 year.
Well, remember their mortgage payments. So if you took out the initial mortgage, if the originating mortgage is about $350,000. Remember, you have origination points. You have all these points. You have insurance that you're paying every single month on top of the mortgage. So if you took out a regular mortgage, that payment may be around $2,500, right?
Right.
This is a reverse mortgage, so it's non-amortizing. It's reverse amortizing. So that $2,500 is just going on top every single month. It's going on top. Okay. In addition, it's a HUD. It's a federally insured mortgage. So just like PMI on a regular mortgage, you're paying insurance on top of this regular mortgage payment.
Okay.
Plus the interest. So it just builds up so quickly. Okay.
All right. So, you answered a lot of questions because honestly, I really didn't understand what a reverse mortgage was. So this, seminar was very helpful and informative.
Thank you.
You're welcome.
Awesome. Thank you so much, guys. This has been such a phenomenal program. Let's give a digital round of applause to Yvette and Rhonda and all of the guest speakers for sharing such great information. Again, ladies and gentlemen, the Du Bois Bunce Center's legal arm launches initiatives such as this to provide comprehensive legal training and support focused on New York's amended housing laws and related legal practices. This effort aims to equip legal practitioners, community advocates, and public interest lawyers with the skills and knowledge necessary to address critical housing issues such as this, including deed theft, housing affordability, and accessibility challenges. By focusing on practical applications of the law that was like what was shared today, this initiative will strengthen the capacity of stakeholders and our community to advocate for equitable housing solutions and navigate the complexities of the state's legal framework. So again, please tap in, subscribe to our newsletter. Our attorneys had dropped their clinic hours in the chat. Make sure that you write down their telephone numbers and their emails, and be sure to join us for our next series. I want to thank you all, and this is under the leadership of Dr. Zalima Blair here in the School of Business at Medgar Evers College. Thank all of our leadership and Aaron, our operations manager, for helping facilitate this event. And we will see you at the next legal session. Thank you.
Thank you, everyone. Have a great night.
Thank you.